thanks everyone for joining in Brisbane. It's just ticked over to the afternoon, so this afternoon. Looking forward to going through this webinar with you on business valuation services, opportunity or cost. It's something that we've been doing at the accounting firm that I run, Inspire, for must be close to sort of 3 or 4 years at a minimum. I can't recall when we first checked in with Grant Bloxham, but anyway, he's going to be running through all about some opportunities that we all have as accountants in business valuation services. Just before we get in that, I might just mention our Facebook community. So if you aren't a part of that yet, feel free to join that with the QR code, or there might be even a link going into the chat box for that. It's basically where I share stuff that's not necessarily in a webinar, but other ideas. Could be scripts I was sharing the other day, videos, tips, anything that we're doing at Inspire, I think that could help our community of accounting firm owners. So check that out if you aren't a member already. And just a brief introduction to me. So my name is Ben Walker. I started Inspire 10 years ago, or almost 11 years ago now, in January coming up, when I was 23 years old. We're Brisbane-based, we're a chartered accountant, and I'm also a published author now of multiple books. Inspire's organic growth has been between 25 to 35% year on year, and definitely a challenge to maintain that sort of growth rate as we get bigger. But that is that's sort of our focus at Inspire, is to sort of constantly be growing. And we've got a team locally, we've got some in India, Philippines, and also we've got a big focus at Inspire of running heaps of webinars. So you'll see just shy of 100 webinars in the 3 years in that range there. And it's one of our primary methods of growing, is sort of educating our prospects and even our existing clients on all sorts of things relating to accounting and tax. So that's a bit of an intro to me and what we've done at Inspire. Now, Grant Bloxham from B-Star. So Grant is considered an industry thought leader on how accountants can grow their business advisory services revenue and attract ideal clients to their practice. He's passionate about accountants offering more value-adding services to their small business clients, and is the co-author of B-Star's annual Accountants and SME research reports. So welcome, Grant, and thanks for sharing with our group.
Good to join you, Ben, as usual.
Yeah, fantastic. All righty. Well, this is sort of where I'll hand over to you, Grant. And I guess just to sort of frame the things that you're going to share, and we're going to hear a little bit around market conditions and current SME client fee rates. We'll talk about the difference between transactional and business advisory valuations, and then succession, sale and exit plans, and also sharing a process that we can follow with help and support. So, take it away, Grant.
Thanks, Ben. Yeah, I thought based on our previous webinar that we did, there's been some really interesting developments and insights that relate to the business valuations and what's happening in the market. So what I want to do initially is go through the different types of valuations, and then really focus on this emerging opportunity for accountants around what we call business advisory valuations, particularly if you have clients in that 3 to 5 years out from succession, sale and exit. In our alliance partner group, the accounting firms that we work with, that's a really big opportunity because they're very profitable and valuable clients. But I want to talk about a process to help advise those clients on succession, sale and exit. And that's critical because a lot of the firms that we work with are really struggling at the moment from a timing point of view. They've got a lack of resources. So it's all about the process to get scale and to deliver benefits to clients and the practice. So I thought we might, if you could just go to the first slide, we'll talk about this new type of valuation that is emerging in the accounting and financial services sector. Generally speaking, what we're seeing, Ben, is there's been a huge increase in the demand for businesses to get valued. And that's mainly because of obviously the COVID and the impact it's had, particularly when the financial benefits have started to be limited. A lot of business owners have looked at their business and said, do I want to still operate, or do I need to get a value where I can exit? So this demand continues to grow and soar at the moment. And typically, a lot of the accounting firms that we work with, when you talk to them about business valuations, they focus on what we call transactional valuation. So you'll see in this diagram here, a transactional valuation is where a client comes to their advisor and says, I've got a specific need. Can you value my business and get an outcome for your client? So that might be looking to acquire, merge, sale, tax planning. I know, Ben, we had a quick chat before we started about restructuring. There's a lot of businesses are seeking restructuring advice from an asset protection point of view. Interesting, what we've also seen is there's been a really high interest in employee share plans or schemes, because what the feedback that we're getting across our group is there's a lack of quality buys. So a lot of business owners, to reduce stress, to pull some capital out of their business, they're looking at their staff and looking at ways to retain their good people, which is important for their own business, but also take and reduce the risk they have. So we're seeing a really big increase in that type of valuation work, and then obviously around finance and insurance. So from our point of view, Ben, not much has changed in terms of transactional valuations. The average market fee for an SME client turning over 1 to 5 million is around 3.5 to 15K. One of the key issues for us with our group, when you're delivering a transactional valuation, you've got to support your valuation with market value data, and that's got to be Australian or New Zealand based. And lucky for us, we do have that data. So that's typically where we caught up last time. That's what we talked a lot about, the valuation from a transactional point of view in the SME client group.
And I even feel just the demand for that stuff has gone through the roof in the last sort of 18 months, particularly as well.
Yeah. So well, like we now get over 250 new valuations a month across our group. So that's a lot of valuation. That's a lot of good data, market value data. But what I was hoping to talk about today was this really interesting opportunity in the client group who are 3 to 5 years out from a succession, sale and exit. And why I wanted to talk about that is they're a very profitable and valuable client group for accountants. And a lot of accountants, when they look forward in 24 plus, they're looking at different ways to grow their practice. This client group is one of the ideal clients for that because they have the capacity to pay. So when we think about growth going forward, and due to things like constraints around staff, we want to get a payback for the investment that you make in terms of advising clients. So we think there's a really good opportunity to introduce what we call business advisory valuations to that SME client group, the businesses that are 3 to 5 years out from succession, sale and exit. And what you see on your screen there in the blue area is a process that we've developed over the last 12 months with our alliance partners, our accounting firms, to be able to offer solutions to that very important and valuable client group. And it starts off, funny enough, with a valuation. And that valuation includes what we call a value gap analysis. And the value gap is, what is the business worth today? And what does it need to be at time of retirement or the next business venture to fund their lifestyle? And most SMEs in our SME research report, in fact, 88% have a value gap risk. So this is the process that we'd like to walk through with your group today, because it's a very important solution for this client group. And it starts off with that valuation gap analysis, and the fee's around $5,000 for that.
Yep. Cool.
And then if your clients have a value gap, what the next step involves is doing an improvement plan, because they'll say, how do I get to the price where I want it to be? And they've got to have a very structured plan on how to do that. And through automation, based on the valuation and the risk and value drive analysis, our system automatically generates an improvement plan because they need to know what to do.
Mhm.
They just can't say, okay, I need to grow my business by $500,000. It just won't happen overnight. And typically for an SME client, that's around a $3,000 engagement. And then what we found is once you do the improvement plan, a lot of business owners need execution and accountability support. And we call that a sounding board relationship. And these are the emerging opportunities for accounting practices, financial planning practices, as they look at this particular client group. And the sounding board relationship for these clients who are 3 to 5 years out from succession, sale, and exit is a board of advice. And the average fee at the present moment is around $1,500 a month.
Mm-hmm.
Then you'll provide succession support. And then ultimately, the client hopefully will be able to exit on the price that they want to achieve. And then you've got the ability to convert that business advisory client into a wealth management client. Now, what we found in talking to our alliance partners is it really needs to start happening 3 years before the succession, sale, and exit event, because somebody looking to come in and buy the business, they'll do a due diligence and they'll want to work out the maintainable earnings of the business, as you know, Ben, because that's what happens when you do valuations. So you want to make sure the client's performance is right on the money. Before they list their business. So that whole process will generate in the SME client group around $82,000 in new advisory work over a 3-year period. And this client group, because they've got value, they're generating sustainable profits, they have the capacity to pay. And that's a very important issue when looking at different areas to grow the practice. And if you've got an integrated business with a wealth management solution, then you actually see the opportunity, well in advance of being crystallized. And we looked at our market value data for SMEs in that 1 to 5 million, and we said the average sale price is around 2.5 million.
Yeah. Yeah, and essentially that turns into that wealth management client from that point onwards. So there's still recurring revenue in a sense for those integrated practices.
Yeah. So it's a win-win. You get the business advisory up front, you get the sounding board solutions for the next 3 years to keep your clients accountable, and then you're able to identify that wealth management opportunity, which is really good for the profitability and value of accounting practices.
Yeah. Yep.
So what worries me, Ben, in the market at the present moment, a lot of accountants are passing over the valuation work, and they may not understand that there's a really good opportunity in this particular case with this particular client group.
Yeah, yep. And I was actually pretty surprised to hear that that quite a few firms don't actually do this sort of work internally. I guess maybe that's something we could talk about at some stage is I guess, in a sense, the system that you've got, how easy it is once you sort of understand how to use it, it is to actually do valuations.
Yeah, and I think the message and why I was so keen today was the valuations will deliver 2 benefits. One, from a transactional point of view, and secondly, they'll source this new revenue opportunity, and it's getting harder and harder for accounting practices to find these opportunities. So that's why we started off and said, is it an opportunity or cost? And we want to make sure that it's an opportunity.
Yeah. Yep. Cool.
But
okay.
If you go to the next slide, what we did over the last 6 to 12 months, we've been sitting down with our alliance partners, and a lot of them were concerned about having the knowledge and expertise to deliver that type of solution. So we started to put together a mind map, because if you want to deliver this solution, it's got to be scalable across your practice. And the starting point looks at who is the ideal client. And there's different ways that you can identify that. You can do some quantitative stuff around, are they out from the sale or the exit of their business? Maybe you look at your top 10% of clients by revenue to see any of those, and maybe thinking of succession, sale, and exit. Obviously, an ideal client is a client that's over the age of 50 with a profit greater than 150, because that means they've got some value in their business. Or some of them said to us, we've got a lot of clients on retainers, and they're all talking about succession, sale, and exit, right? So when we started to put the process together, what we wanted to do is say, how do you identify this client? And that might be a part of the process to work out whether you invest the resources to go down this path. And there's some ideas around that ideal client.
Mm-hmm.
Then the next step is education. We find that industry benchmarking information, and I'll go through this in the next slide, is so powerful to get clients engaged to want to value their business. And I'll explain why when we talk about that soon. But also there's an education gap, particularly if the succession plan looks for a young person to buy in the business. Most of them don't know how to value the business. They don't know what a multiple is. So there's an education gap that needs to be addressed. And obviously you can help educate through articles and case studies, because the more you educate clients about this process, the higher the engagement, the higher the trust. And then, as we've talked about, Ben, it just starts in step 3 with evaluation.
Mm-hmm.
And that valuation process in this particular client group includes a gap analysis. Remember, 88% of business owners have a value gap risk. And then technology enables you then to do what we call a what-if calculation. So if we change a few things, look at ways to improve profit, improve cash flow, lower risk, this is the potential value. And then obviously it's important that you revalue the business each year, because you want to show the clients how their value gap risk is reducing. So again, the valuation of the business is the starting point for a lot of things. And when you look at growth going forward for accounting firms, this is a big issue. And then there may be a planning element where you've done a valuation, as we've talked about, it doesn't meet your client's expectations. So you can then start to work on improvement planning. You can use benchmarking data to identify areas to improve. A lot of our alliance partners, when they do a risk and value driver assessment analysis, they'll use it during a strategic planning day, because sometimes not all the owners are aligned on where they want to take the business.
Yep.
And that comes out of the valuation.
Yeah, in the RAVDA.
Yeah, in the RAVDA, and you've done it. I mean, it's one of the most popular tools we have, because if you've got multi-owner businesses, you can show them where they're aligned, not aligned.
Mm-hmm.
So we need to address that issue before we document your succession plan.
Yep.
And then obviously over a period of time, you're able to build and document their succession, sale and exit plan. But the single biggest issue in step 5 is, once you value the business, you've got a plan in place, SME clients, small business clients, medium enterprise clients, they need execution and accountability support. And what that means is, the accounting firm, the financial planning business, doesn't do all the work, but they become the focal point, the sounding board. And you're able to charge a good monthly fee for that, and also work with your team of experts in areas that you don't specialize in. Maybe there's a HR issue that needs to be addressed, IT, marketing. And then you've got your traditional centers of influence around finance, lawyers. But they need to have somebody to hold them accountable to implement the action items to get their business to where it needs to be.
Yep.
And then they get their end goal. The end goal is to achieve financial independence. And this is the process. It's not about an individual person's expertise. And it's an automated process. So it's a step-by-step. And the good news is, if the client doesn't like the valuation and they're not happy with the outcome, which does happen, then there's no commitment to go to the next steps, planning for support 5.
Yeah, I see. Yep. Yes. Cool. Okay.
So yeah, that's this sort of process that we put together when we announced the insights for our group. And the feedback that we got is, we need a process to follow. And that's a summary of what we've done, which is really good.
Yeah, great.
Okay, the benchmarking data.
Very good.
It's absolutely important, if you're working with this client group, that you can use industry benchmarking information to really get clients engaged, raise awareness, and set expectations. So on your screen, you'll see there's two different industry benchmark reports that have been generated from our benchmarking system. The first one is what we call an industry business value assessment report. And what that does, it finds the market value multiples for an industry in which the client's business operates in. So in this case, we've asked to value an architectural services business, and we set a revenue range and a date range, and there's 24 market value multiples, and it's all Australian data. We've got over 8,000 benchmarks. And what this report does, if you go down to the little red box, it highlights the industry average cap rate or profit multiple, and the industry benchmark, which is the average of the top 20% cap rate or profit multiple. So when you're starting to talk to your clients and the clients say, I'm thinking of selling my business, can you give me a ballpark what it's worth? This is where benchmarking data becomes so powerful, because you quickly download a report to see if that meets clients' expectations.
Yep.
There's a lot of people talk about rule of thumbs when you're restructuring, where we did a webinar earlier in the year about restructuring valuations. And I said, please don't use rule of thumbs because the Australian Tax Office doesn't like that. And a gentleman rang me up afterwards, one of the accounting firms, and said, can you send me one of your industry reports? And I said, why? And he said, oh, we've done a restructure and they used a multiple of 1.5.
Oh dear.
And our data says the average was 3.5.
Oh, yep.
Right?
Oh dear.
Oh dear. But when it comes to this client group, what it does, it sets expectations. If you want to do a restructure, you can then say, well, let's do some financial modeling on these multiples, because a lot of clients don't know. And it's all Australian-based data, which is great. And a simple thing like if clients come to you and says, I'm thinking of selling, you say, well, you turned over 2 million last year. Your profit was 10%, so 200 grand. And by a multiple of 3.38, there's 600,000 or 700,000. How does that fit?
Yeah.
And if they don't like it, then that's when you can say, well, let's do a valuation to get an understanding where you really fit in terms of the value of your business. Now, the second report is the industry financial performance benchmark reports. And what this report does, it highlights the top 18 key performance indicators, again, for businesses in the client's industry. And the ones that we always focus on when getting engagement for transactional business advisory valuations is the earnings before interest and tax, and the WIP, stock, debtors, and creditors days. Now, if you think about valuing the business, the first thing is you've got to work out the maintainable earnings. Well, this particular report shows the industry average EBIT margin. In this case, it's 16.6%. The benchmark, which is the average of the top 20, is 24.1%. So very quickly, using these two types of reports, you can get engagement with clients around getting them to understand truly what their business is worth without going through the process to start with. So that way you can protect your client relationship. And so many of our alliance partners now, the people that we work with, they're embedding these reports with all these, with the clients that meet that ideal client profile. And our data is considered the most accurate because it comes out from all the other valuations where the profit has been cleaned out through add backs and deductions.
Yeah, okay. Yep. Fantastic.
And the other interesting thing, Ben, when it comes to benchmarking data, is what you can do, you can show clients the improvement in the value if they were to achieve benchmark performance.
So go from, let's say they're at 10%. I mean, even to industry average, this client would be up a lot, but suggesting they go to this one here.
Yep, correct. And then you can actually work out the financial difference in the value of their business. And then they say, well, how the hell do we do that? And that's where the improvement plan comes in once you value the business.
Yep.
So one of the strong recommendations from this session today, and I know you're an advocate of this, if you're looking to target this client group, which is very profitable and valuable, use benchmarking data to educate, to raise awareness, and to engage. and it takes less than 2 minutes to generate these reports.
Yep. Yep. And even like we're doing a lot of what we call AGMs at the moment. So delivering the tax returns for 2023. And so this sounds like it'd be a good conversation to have, to sort of use 23s to have a conversation and to get them into this business advisory style program.
And the data for us, Bennett, it all comes from the valuation tool. So that profit figures that are highlighted there, the EBIT figures, they're after adjustments for notional salaries, add backs, instant asset write-off. So it's considered the most accurate data you can get. And that's really important to get clients on board to engage them in this journey.
Yeah. And I guess that might be a bit dangerous in the sense just to look at their financials, prepared for lodgement with the ATO to suggest that that could be their EBIT. So
and there's always a difference. There's always a difference. But the good news is the data sitting in our database, the benchmarking data, is not from the ATO. It's not from the zero accounts. It's in the system after all those adjustments. So it's very powerful information.
Yeah, great.
But for business advisory valuation, very important engagement tool to use this data. Okay, so let's have a look at what happens once you've done the valuation. As I mentioned in my introduction, a lot of business owners have a value gap risk, and they need some time to get their profit, their cash flow, their risk and value drivers up to a level where it achieves their price. So one of the great things about automation is once you've completed that original business valuation analysis, you can do a what if analysis, and that's very important because it sets some targets to help clients go down the path of the improvement journey by saying, well, if we change some of your profit, if we can get your debtors days down lower to improve cash flow, and we look at some of those risk and value drivers, particularly around maybe systemizing the business, let me show you the difference in value. And why that's so important, because it then enables you to charge a reasonably good fee, because the client can see that they can grow the value of business, in this case, from 1.6 million to 1.9 million. And showing them improvement takes their focus away from costs to making sure that they invest with you to do this type of work. But again, automation, Ben, it's a very simple process. Takes 5 to 10 minutes to complete, and you put it on the table with the client and say, hey, look, here's the numbers.
Yep. Yeah, fantastic.
Yeah. If you go to the next slide, then it leads into where we see the big growth area in the accounting and financial services sector, and that's what we call a sounding board relationship. So if you've done a valuation and there is a gap and you've put together a what if analysis supported by an improvement plan, the next step is to set up a sounding board relationship. And with business clients, there are 3 different sounding board relationships. For the small clients, it's about becoming their mentor. For SME clients, the smaller ones, it's around being their virtual CFO. But for this particular client group, where they are 3 to 5 years out from succession, sale, and exit, it's a board of advice program. And we're pushing these services and these solutions within our group, because what it does, Ben, it builds recurring revenue from a fee-for-service arrangement with the client. So the sounding board solutions, whether they're mentoring, CFO, board of advice program, all priced on a monthly fee. And in the SME sector, for a board of advice program, it's $1,500 a month.
Yep.
So we're now starting to change the dynamics in the accounting firm, but most importantly for a client, the sounding board solutions focus on accountability and execution support. And what you see on your screen is the structure and pricing for a board of advice program, which I'd like to go through now. And these are the exciting opportunities coming out of the group. So if you look at the first stage in that board of advice program, Ben, you've done a business value assessment. And we've talked about that using the benchmarking data, the gap analysis, the what if, and you've come up with what we call the financial independence value. So you're able to demonstrate to the client this is the price that you need to live the retirement lifestyle that you choose. So that's at the front. And then the second step is, like a CFO service, is to set up and do an annual budget with your clients.
Mm-hmm.
And that's focused on profit and loss and cash flow. And then obviously you want to have regular meetings with your clients. Initially, it might start out at a month-by-month basis. If the client has some high concerns, obviously the fee would be higher. But normally a board of advice program, there's 4 meetings a year. And you prepare a charter. You've got an agenda through the accountability app. You do, in each meeting, your review of your budget, your forecasts.
Mm-hmm.
And here's a really important point. And we found it when we analysed CFO services. If your regular meetings with your clients focus solely on the numbers, like a CFO service, budgeting, cash flow analysis, et cetera, we found in our group, they have about a 2-year shelf life. And after a while, the client says, well, Ben, we've got our numbers right. We've got our debtors under control. We've got our costs streamlined. What's next? So this is really important that you extend your meetings from just looking at the numbers. Otherwise, they have about a 2-year shelf life. So in this particular case, not only do you go through the numbers, but you also look at some key strategic issues identified in the risk and value driver analysis.
Mm-hmm. Yes. Yep.
Right. So you might say, we're going to have a deep dive into how to systemize your business, because that might be one of the key issues for the client. They don't have an operations manual. They don't have good data on who their clients and what they buy. So the great thing about these meetings is not only focus on the financial value drivers, but also the non-financial value drivers. And when you have these meetings, if there's a particular issue that comes up that needs to be addressed and you don't have the expertise, obviously you'll bring in specialists. It's really important you say what you can and can't do.
Mm.
Another critical thing about setting up a sounding board relationship is keep your engagement letter really tight. Because a lot of your clients will say, hey, Ben, can you just do this? And can you get this for me done? And that's when it starts to eat into the profit margin of this service, because it's not in the scope. And that's what a lot of people talk about when they use the word fee creep. And for us, we wanted to build an application that would enable our alliance partners to streamline their meetings and focus on accountability. So our alliance partners use what we call the accountability app. And in the accountability app, one of the great reports is the closed action item report. So after you've had your meeting with your clients, you've updated their action plans, you've had a look at their financials, you've done a deep dive into one of the areas that maybe they want to improve non-financially, you can issue them a report with all the closed action items. And you can say to your clients, look what we've done over the last 3 months or last 6 months. And why I raise that is that helps quantify value. And quantification of value can be financial or it can be non-financial. Now, you need to quantify value to retain the retainer. So when you do the Board of Advice program, each year you do a business revaluation, because you can show your clients the improved value of their business. But also what the accountability app does, and when you focus on execution accountability support, you can show them closed action items. Look at all the stuff that we've done.
Mm-hmm.
So one of the key things, Ben, when you're working with clients on a regular basis and you're helping them improve their profit, their cash flow, growing the value of the business, you've got to quantify the value of a service to retain the retainer. And in this case, it's using the closed action item report, which is non-financial, and doing a business revaluation to show them the improved value, the lower the gap risk.
Fantastic.
And using technology, you can get about a 33% efficiency gain. And these are the sort of solutions as accountants look for growth over the next 12 to 24 months, particularly in this client group, is a no-brainer. They need help to execute. Giving them a plan, most of them will leave it on the shelf and won't read it again.
For sure.
But it has a direct impact on the value of an accounting practice because the multiples, as you know, you'll do a RAVDA analysis on the firm and it'll have a higher multiple because it's got recurring fee-for-service revenue.
Yeah, for sure. Yep.
So that's important. And then the final step, I guess, when working with, if you go to the next slide, is talking and helping them about executing their succession, sale, and exit plan. And the role we see for accountants, financial advisors, is really around a project manager role, where you do the things that you can do well, and then you work with a trusted team of experts to help your clients. That's where you outsource the specialist work. We always encourage our alliance partners through that sounding board relationship to really focus on action item implementation. And if you can start that process with your clients well in advance of their actual event, then there's going to be a higher outcome for your clients, which is wonderful. And then obviously, as we've talked about, when it comes to succession, sale, and exit, there might be other areas that your clients need advice in, finance, insurance, legal, HR, IT, marketing, even fitness, mental health, and family counselling. But a lot of the firms, well, most of the firms we work don't have that expertise. So we try and encourage them to be very clear to the clients and say, but I may know somebody in my network that can help you. So up until that sort of relationship, there's about 82,000 in fees, new fees, on the table over a 3-year period. And the profit margins in this work is astronomical compared to compliance work. And the key thing is to have a process to follow. And it all starts with that business advisory valuation because it builds trust. And once you've got that trust, you can do anything with clients. And that's what worries us at Vista. A lot of accounting firms, financial, are giving that opportunity away. And that's why I was very keen to do an update session with you, because in our group, it's become a top priority because the clients have the capacity to pay.
Yeah, that's it. And when you say they're giving that work away, is that, you mean like they're getting another firm to perform a valuation?
Yeah. Or
yeah.
a provider, and the quality of that service is, I've seen some is really worrying. So, but I just think in this particular client group, if you have any of clients that meet that ideal profile, then, do your numbers and work with people like yourself, Ben, to get it done.
Yeah, cool. Okay. No worries. Well, we're going to go to questions pretty soon. So feel free, if you're listening, to pop a question in the chat box or the Q&A box for Grant. But yeah, I guess if someone's listening who wants to get in touch with you to discuss what it looks like, getting access to the platform you've got, how do they go about that?
Oh, they just send a message to your team, and then we can contact them. I hope from today's session they can look at their client base and say, do we have any clients in that particular client segment, right? And if we do, this is a process that we could follow to get more revenue for our business and help our clients. Because I know how busy accountants are. But my point right at the start was, if you're going to invest time delivering services to clients, make sure it's profitable work.
Yeah, yep, for sure. Yep. Okay. There you go. Alrighty. And I'd just like to know, anyone who's keen to share, what are you currently doing with valuations or even that sort of business advisory style work that we've talked about? Alternatively, if anyone has a question, just pop it in, and happy to work through.
Yeah, just a bit of a warning there. If you're doing valuations or outsourcing, make sure the provider's got Australian or New Zealand market value data. One of the good things that we do at B-Stars, we provide that, and it's all Australian or New Zealand based, and we got over 8,000 multiples.
Yeah, okay.
It's become a really big issue.
Yeah, I actually saw an account I had outsourced a val to someone near my office, and it looked like they were sort of that's what they did, valuations. But the report I looked at was quite bland with that market comparable data, and it looked like very round multiple of a set 3. Like, how does that happen?
And that's the risk, and that's what we're getting feedback in the market, and we're saying to our alliance partners, the good news is you've got market value multiple for Australia with us, and you're right, Ben. That's what's happening in the market. You just got to be really careful, really careful.
Yeah. Okay. Alrighty. And yeah, Laurie just asked that question. Is it commonly outsourced? I'm guessing, Laurie, you mean the valuation process for firms who don't have that capability inside? Yeah, that's what he meant. Cool. Okay. And then, Grant, if you're a firm who's not done valuations before, how do you, what's the process you take people or let's say the partners or partners and managers through to get them, I guess, valuation ready?
Yeah, so we offer a valuation tool and benchmarking training, and the first training session, there's 4 training sessions in total. We'll show them how to use the benchmarking data to engage clients, and then we'll go through the valuation process. And then we'll help them with their activity. Support's really, really important. The second one is then we'll show them that how you can do an amalgamated RAVDA with multi-owner businesses. So we have a 4-meeting program that is really centered on making sure they deliver the right outcomes. But the good thing is, again, if there's something wrong, they'll ring us or our benchmarking data, because as you enter the information, as you know, Ben, it displays benchmarking data live. And that's really good to make sure they're not making any mistakes. So yeah, it's 4 sessions, and then they're able to deliver it. Then we hold their hand if they've got any queries, they can ask. But as I said, we get 250 new valuations a month. So the accountants trust the solution.
Yeah, and it's been fantastic. And just sharing from our personal experience at Inspire, I've taken quite a few of our team through that sort of process of teaching them valuations, and they're I mean, we still often get a handful of curly questions or bits from each valuation that we do, stuff we haven't seen before or weird inconsistencies. But yeah, if we can't work out the answer within the team, Grant's been fantastic at providing that support, and super quickly too. I do want to share that with the group listening. I don't think we've waited more than 24 hours for a response, but usually it's within an hour or two. Grant gets back to us with some guidance. So,
and the other thing, Ben, just one of the key things that we're finding is independence is an issue. So having benchmarking data to validate your key assumptions really helps your position as being independent, which is important. So
I see.
These things are critical if you see this as an opportunity, and the opportunity could be transactional or could be business advisory. So, and that's where the growth area is starting to emerge in the accounting sector.
Yeah, for sure. And I know with quite a few of our restructures, they're usually total fees in excess of 10, sometimes up to 20K to perform that restructure, including valuations and advice around CGT, but often with fantastic outcomes for clients. So, I couldn't do without having that capability within Inspire.
And that's why when I see some people delivering valuations for below $1,500, I just worry about the quality, and it'll come back and bite the firm, because the tax office and ASIC are really ramping up resources to look at this. And so I think there's going to be a cleaning out process. So the key thing is have the good data and a good process, which is what we're able to offer.
Yeah, yep, fantastic. All righty. Well, if there's no more questions, we might wrap up there. And I just want to thank you, Grant, for sharing with our group.
My pleasure.
Really appreciate that. And if anyone wants to get in touch with Grant, feel free to reach out to us and our team, and we can put you in touch with him and take it from there. So.
Yeah, I think key message is don't let this opportunity go, Ben, because it's getting harder and harder to find gold nuggets in accounting firms, and this is one of them.
Yep, for sure. And demand certainly
high.
Ramping up for sure. All right.
All right.
Thanks again. Cheers.
Thanks for the opportunity. See you, Ben.
Thanks, mate.